Morning, everyone. Morning, morning, morning. I'm going to give this a couple minutes, make sure no one else jumps on here. And I keep getting texts from some of my real estate agents that are signed up for this. I do send the recording out, so no worries if you miss it. Shout out to Mindy, who's showing a $600,000 house this morning. Good for you. Good luck with that. And if you need a pre-approval, let me know. All right. So today, what we're going to do, I had a customer come in this week, and let's get the slides going. I think we already went over this. This is a weekly quick mortgage puzzle. I don't like calling it a webinar because it's quick and out of here, but I hadn't thought of a better word for it. Anyways, had a customer come in this week, gonna buy his father's house. And, I'm talking to the son about what his goals are, what he wants his payment to be, what he wants his cash to close to look like. We went over options. He's got money in his savings account. He has an IRA that actually he can cash out some to buy a house. I didn't realize you could do that on an IRA, but you learn something every day. Used to definitely 401ks and getting money out from that. And he wants the lowest payment possible. Here's the twist though. His dad bought the house back in, I think 2008 for like 50,000. And it's worth over 350. It's getting close to 400,000. And 275 is what the dad wants to get from the property. So when I'm talking to the customer, I also want to talk to the dad, to talk to him about his goals so I can relay the information to the real estate agent so they can write the contract correctly. But gifts of equity are useful, and they're more useful than just getting the customer into the house for as little as possible. With the amount of equity that's in this house, we can do some creative things. We can not only give a gift of equity, which is just like any other gift, for just the down payment or just the closing costs needed to where they can get into the house for zero. We can give enough of a gift of equity to where the customer is putting more than 5% down. The customer is putting 20% down, 30% down, 40% down. And you might think that that is not important, but if you put enough down, you're going to avoid mortgage insurance. You're also going to avoid loan level price adjustments, which means if you're putting more money down, you can have a better interest rate on the file. It's also easier to get it approved. Not that this customer has a problem getting approved because he has high 700 credit scores. You can give a gift of equity to pay debt off for the buyer as well. So let's say he had a $20,000 credit card that he had a $700 payment on. You can give that in there as well. So there's a lot of creative ways to get that taken care of, but it was important for me to talk to the dad who was doing it, because when I talked to him about his son and what his goals were and how he was going to get the money, he agreed that he'd rather his son not take his money out of his investments. Let's give a bigger gift of equity. The father's still making what he wants to make on the house, just on paper. We're making it look different. So the son's not going to have to get money out of his IRA now. The son is not going to have to deplete all of his savings account. The son's not gonna have mortgage insurance on the loan, and he's gonna have the best rate possible for that scenario. So that's kind of my puzzle piece for this week. Does anyone have any questions about how to set up a gift of equity? If you do, when you're writing a contract, feel free to give me a call. I'll be glad to go over it and tell you strategic ways to structure that. Or does anyone have any other questions about scenarios, appraisals, credit, income, anything like that? All right. Going once. Going twice. All right. We're done. Thanks so much, guys. See you next week.